published by the end of May. For this webinar, we have an excellent lineup with, first of all, Oleg Shmelyov from the EBA, who participated in the drafting. Then we also have Panachotis Pazoglou from Shufa, a credit reference agency. We have Françoise Pal-Goulabert from the Association of Française des Sociétés Financières. So she is representing the French consumer lenders. And then we have Olivier Yerusalemi from Finance Watch representing the consumers. So before I give the word to Oleg, I would like to also briefly introduce myself. So my name is Willem-Pieter de Groen. I'm a research fellow and head of the financial markets unit at SEPS, and I will be moderating the debate. During today's discussion, it's possible for you as participant to ask questions to the different speakers. For that, I would like to ask you to use the Q&A button in front of you. We will first start with some presentation introductions by each of the speakers, before which we will have the discussions in which also your questions will be raised. I will leave it here from my side, and I would like to hand over to Oleg to present the guidelines on loan origination and monitoring.
Thank you, Willem. Oleg. Thank you, Willem-Pieter, for this introduction. Good morning, ladies and gentlemen. It's my real pleasure of being here and presenting to you. I will try to share the slides, which I, for some strange reasons, cannot see anymore how to share them. Sorry.
Okay, here it is going to be.
Do you see it when you?
We see your folder with the loan origination presentations.
Right, I think it's crashed. I do apologize for that.
Okay, I will ask our host, Beatrice. She will put these slides for you up, and then just tell her when you move on.
Right, well, anyway, I apologize for this technical hiccup. And thank you, Beatrice, for showing the slides. Well, my real pleasure to discuss with you and present our work is something what we have been doing for the last couple of years at the EBA, the guidelines on loan origination and monitoring. And in many extent, this is the first guidelines where we have tried to do quite a lot of new things for the first time. And if we move to the next slide, please. This is just a bit of the background. The loan origination guidelines come from the past crisis. So although we are now preparing for the dealing with the aftermath of the COVID-19 situation, the idea of the reinforcing banks' practices on the loan origination comes from the previous crisis, where we have seen tremendous amount of non-performing loans. And we had 1.2 trillion non-performing loans. And the ratio since the introductions of the common ratio, non-performing loan ratio was 6.5. Now we are down to the all-time lowest non-performing loans ratio, 2.7%. We halved the amount of non-performing loans thanks to the policy response, thanks to the bank's actions, and also thanks to the improving macroeconomic conditions before the COVID-19 situation. So we are down to only 583 billion of non-performing loans. 2.7 is the non-performing loans ratio across the EU. However, the situation is still different across the countries. We still have some outlier countries with double-digit non-performing loan ratios, namely Greece and Cyprus. But overall, the situation has significantly improved. However, as I said, this is all before the COVID-19. This data is until December 2019 here. And we are all expecting the macroeconomic conditions to deteriorate. We're all expecting the quality of the loan portfolio to deteriorate, and we're all expecting to see the increase of non-performing loans in the future as a result of the COVID-19 situation. But as a background, we were all preparing for the situation, for this situation in the future. And if we can move to the next slide, please. Here you see the comprehensive European response to the past crisis, which was introduced in 2017, in July 2017, when we had the non-performing loan ratio of 4.4%, and now we're down to 2.7%. And this is the comprehensive action plan from the Council, which was meant to address the stock and inflows of non-performing loans, which we saw after the previous crisis, in a very comprehensive and thorough fashion. So there were supervisory measures, there were policy measures addressed to the prudential treatment of non-performing loans. It's the famous backstops, it's the famous management of non-performing loans, the guidelines issued by the EBA, the SSM guidance, and the supervisory guidance for the significant and non-significant banks. Here we have the macroeconomic and macroprudential approach, and here we also have the attempts to harmonize and simplify insolvency procedures across the country. So the response is very comprehensive. Most of these actions have been already taken and addressed. I think at the moment we are still some lagging behind. Where we collectively lagging behind is the insolvency procedures. But as you see here, and you will get the slides later on, most of the actions are about the dealing with the stock of the non-performing loans which we had at that time, and also inflows of the non-performing loans. So we were not really preparing for the future, with the exception of the guidelines on loan origination and monitoring. This was the future forward-looking mandate, where we were asked to develop the guidelines to ensure that later on in the future, if we have a repeat of the crisis, the banks are better prepared. The quality of the loan books should be of high, or should be better compared to the previous past experience, and we will ensure that the levels of the NPLs we have seen in the past crisis are not that high and more manageable, and also the banks are better prepared. So these guidelines come from the non-performing loans file and from the past crisis. However, if we move to the next slide, what we have tried to do in the EBA is to have a very comprehensive approach. And in this approach, we have many first times what we have done as the EBA, because for the first time, we actually went into the bank's core practices. It's not about the prudential treatment, it's not about the risk management, it's about the business, and we try to influence the business decision of the banks to ensure that already creditworthiness assessment and assessment of the credit risk from the perspective of the banks is taken into account very thoroughly at the point of loan origination and the core of the banks generating new credit business. For the first time, we also try to merge consumer objectives and the prudential objectives and introduce various elements into these guidelines, future-proofing the framework. So in our guidelines, we have 8 sections. First of all is internal governance sections. This is addressed to the banks, where we are explaining the existing internal governance requirements. In the EBA, we have issued very detailed internal governance guidelines which cover all aspects of the governance of the institutions. Here in the loan origination guidelines, we're trying to put this into the context of the credit decision-making and credit taking. So we are elaborating on the general governance principles in relation how they should apply in credit decision-making, in risk management and control. We also deal with the IT and data infrastructure. This is something which we saw from the dealing with the non-performing loans from the past crisis, that the data associated with the non-performing loans is generally quite poor. And in order to be able to better resolve the non-performing loans in the future, we should have a better data. And loan origination, the creation of the loan, is the best point to get the data from the beginning. We also addressing the technology and technological innovation, dealing with the requirements for the various automated models which are being used by the banks and creditors in credit decision-making, in assessment of the borrower's credit worthiness. So all these models are recognized in the governance requirements, and we provide some general model governance framework for those models. And last but not least, we are trying to future-proof guidelines as far as possible, there is a section on setting the requirements for the fintech. So not the traditional scoring models, automated models, but some future developments in the modeling work and artificial intelligence and things like that. In these guidelines, we are trying to set the basic requirements for that. At the core of the guidelines, we have the section on the creditworthiness assessment, which deals with the requirements for the actual assessment of the borrowers when they are applying for the new loan or renegotiating existing loans and making changes to those loans. The requirements are very proportionate in our view. It's something which we have discussed a lot during the public consultation, and we have adjusted the final guidelines quite significantly to ensure that we have proportionate approach to consumers, where we also look at the secured and unsecured loans, to ensure that we have proportionate approach to the corporates, where we separate the requirements for the micro and small enterprises and then to medium and large enterprises. So we try to be very proportionate in this regard. And also in the creditworthiness assessment, we are dealing quite a lot with the automated models and setting the requirements, mirroring the governance requirements. We're introducing how the models can be used in creditworthiness assessment. Moving on, we also set the risk-based requirements for the pricing. This is perhaps the smallest part of the guidelines, where we look at the general criteria to ensure that the loans are actually priced according to the risk. Also recognizing proportionality and also recognizing that it's not always possible. So there are different approaches to consumer lending and the pricing of the mortgages. There are also different approaches, not necessarily risk-based, for the pricing of the promotional loans. So we think this balance of different approaches to pricing is also in the guidelines. There is also a big chunk on collateral valuation. This is something which we think is very important, and where we also saw quite a lot of deficiencies when dealing with the resolution of the non-performing loans from the past crisis, that the valuations of collaterals have been quite out of tune and sometimes very significantly out of tune. So the best time to ensure that the valuation is right is at the point of the origination. So in these guidelines, we set the requirements for the movable and movable property collateral valuations at the point of initial origination, revaluation, and monitoring. And interestingly, we are also trying to push the boundary of the innovation as far as possible within the prudential rules. We're introducing there the requirements for the use of the advanced statistical models for the purposes of the valuation. And last but not least, the section is dealing with the monitoring framework, where we expect banks to monitor the quality of the credit portfolios, the monitor of the borrowers, do the regular credit reviews of corporate borrowers, and improve their data and IT infrastructures for the purposes of the monitoring. So this is all which most well-governed banks are already doing, so there are no surprises in this guidelines. Now, as I said, we are trying to future-proof the guidelines as far as possible. So there's a lot of new innovative text on the use of automated models in credit decision-making, automated models in the valuations, automated models in the creditworthiness assessment. We have also introduced a link between the creditworthiness assessment and with the procedures dealt for the anti-money laundering and countering financing of the terrorism, to ensure that the information is used coherently across the different sections within the institutions. And there is another innovation. What we have in these guidelines is, for the first time ever, we in the EBA policy products, we are dealing with the environmental and social and governance factors, and expect institutions to do the assessment of the ESG factors and related risks when they grant new loans. So if we move to the next slide, please. As I mentioned, for the first time in the EBA history, we are trying to merge different angles. And I think this is very important also for these discussions and for the title of this discussion, responsible lending in the time of crisis. In these guidelines, we are trying to merge prudential objectives, ensuring that there is a prudent risk taken and management of the banks, of credit risk within the banks, and the consumer protection objective. By merging that, we also hope that we're ensuring the financial stability, because the financial stability can get affected both from the prudential side, where the banks are not necessarily good in managing their credit risk, and then we have the increase of the credit risk, and then we have the tie-up of the bank's capital and other financial resources with dealing with the non-performing loans, as opposed to lending this money to the real economy. So we need to ensure that the banks themselves have very sound policies, processes, and procedures and approach to setting the risk their risk appetite, managing their risk appetite, and managing credit risk against their set risk appetite to ensure that they actually take in the risk what they can afford. So this is the prudential angle, helping with the financial stability. And there is also a consumer angle, that to ensure that the borrowers are actually able to afford the loans and they have the suitable products offered to them. And the borrowers can afford the loans considering all their financial and non-financial regular commitments. So this is a creditworthiness assessment from the point of view of the consumer. And then we also expect that there is a no detrimental effect to the financial well-being of consumers, following that their creditworthiness is properly assessed and they are offered credit products which they actually afford. And this is also contributing to the financial stability. So we see this continuum of different objectives, all contributing to the increasing financial stability in the sector, whilst protecting the interests of the consumers and whilst also respecting prudential requirements applicable to the financial institutions. And this is important objective also in the light of the COVID-19 situation, where with all the flexibility which being currently offered by the institutions to the borrowers having some financial or liquidity difficulties, we should not forget that there is obligation for the banks also to manage credit risk to ensure that we have sustainable recovery from this situation, and we have good, well, relatively good as far as possible credit view on the future. And now if we move to the next slide, please, which is the last slide in my presentation, is regarding the implementation of the guidelines. Now, interestingly, we have been working on these guidelines for quite so long time. We were ready to publish the guidelines after very extensive consultation, which amounted to more than 800 pages in total, just before the COVID-19 situation. Then we decided to delay the publication of the guidelines to allow the banks to focus on their immediate priorities. And we have also adjusted the implementation of the guidelines to give more flexibility and more time to deal with the immediate problems facing the loans and facing the bank's activities. So there is a three-step approach to the implementation of the guidelines. First, the guidelines apply to the new lending starting from the June 2021. So all new loans which will be issued after that date will need to follow the creditworthiness assessment requirements which are set in these guidelines. And this is very important. This is important not only for the banks, but also for other lenders, because when dealing with the lending to consumers, the guidelines are taken into account the requirements of the Mortgage Credit Directive and the Consumer Credit Directive. So those sections dealing with the lending to consumers are applicable not only to the banks, but also to the creditors under the Mortgage Credit Directive and the Consumer Credit Directive. However, to facilitate the bank's response to COVID-19 situation, we are offering additional transitional arrangements of the additional 2 years from now until June 2020 to not apply the loans, to not apply the guidelines to the loans which are currently in existence but have been renegotiated in light of COVID-19 development. So the renegotiation, application of the guidelines to the renegotiated loans will kick in only in June 2022. And there is additional transitional arrangement to address some potential data gaps for the existing loans in the monitoring process, and that will be until June 2024. So the banks will have 3 years from now to adjust their data sets for the monitoring purposes for the existing loans. For the new loans, they will need to collect all the necessary data and monitor all the necessary data from June 2021. But if they have some data gaps in the existing loans, they have time to collect this information through the regular credit reviews of the borrowers, which is also in line with these guidelines. So by doing this manageable and proportionate approach to the implementation of the guidelines, we think that we're also addressing the current challenges the institutions are facing in light of the COVID-19 situation. This additional 2-year transitional period for the data gaps, for the application of the loans to the renegotiated loans, and 3-year period for the data gaps will help them to focus on what they need to do in response to COVID-19. But we want to ensure that as soon as we are out from the very immediate response, the future loans are thoroughly assessed based on these comprehensive requirements in order to ensure that we have more stable recovery from the crisis and not just generate potential time bomb with the lower quality of the loans being booked now. And thank you very much. I stop here and well, happy to take questions as Roel and Peter will decide either now or later on. Thank you.
Okay, thank you very much, Oleg. If you have questions for Oleg, please use the Q&A option in the Zoom at the bottom of your screen. But before we take the questions, we move on to Françoise. Oleg already mentioned that basically COVID has a large impact on the sector. Could you put some more light on what the impact is as far as you can see now, as well as what you and your members think about the guidelines? Françoise.
Thank you. Ladies and gentlemen, thank you for this kind invitation to this roundtable. This webinar is a great opportunity to exchange views about responsible lending in time of crisis. And I would like to thank warmly the organizers of this webinar. It's always a pleasure to exchange views with the EBA and all the stakeholders, especially Finance Watch. I have 5 slides in my short introduction. The first one is about ASF, the French Association of Specialized Financial Institutions. Next slide, please. We have 280 members and we represent 20% of the credits to the real economy in France, around 250 billion euros in current transactions. Our members are finance companies, credit institutions, specialized banks, investment firms, and they are offering specialized finance to households and businesses through 8 business lines: equipment and real estate leasing, factoring, consumer credit, and also investment services, securitization, guarantees, home loans. You can see the huge volumes in the EU on the screen. The ASF, through consumer credit and leasing activities, is very much involved in financing the green economy. Our members are pan-European players. ASF members are amongst the first 3 European players in leasing, factoring, and consumer credit. And the ASF is very much involved in the 3 European associations: Lease Europe for leasing, Eurofinas for consumer credit, and EUF for factoring. My second slide is on the impact of COVID crisis. In this exceptional crisis, we are all stuck together. On consumer credit, we represent 50% of the French market. Lenders have faced a sharp decline in their activity during the lockdown period. In France, in April, new credit granted decreased by 68%. Car finance was particularly hit with a decrease of 90%. On factoring, statistics are generally good in the first quarter of 2020. However, with the economy coming to a sudden halt, we expect a sharp decrease from April. Credit insured lines will be affected by reduction or cancellation. Risk is expected to rise. On leasing, there was a sharp decrease in production, auto lease, leasing of professional equipment. In the next slide, you will see what ISF has achieved to provide answers to its members. ISF members have responded to demands in credit payment deferrals in April and May, respecting responsible lending on a case-by-case basis for targeted segments of clients and triggering consumer credits contractual clauses that allow temporary payment deferrals. The ISF has worked with the French Banking Commission on efficient private moratoria for businesses in line with EBA guidelines. For consumer credit, moratoria have not been necessary in France due to efficient governmental measures dedicated to households with temporary unemployment allocation scheme and state guarantee scheme for credit to allow enterprises to pay the wages. So the power purchase of households was secured. The ISF has proposed to the government solutions to accelerate the economic recovery. In leasing, a sale and leaseback tax package to provide access to financial resources to corporates and help the energy transition. In factoring, a solution to finance orders via factoring to accelerate corporates' cash recovery. French factors are currently involved with the French government in this proposition. The ISF has asked, like other European federations, for a temporary ease of the prudential framework. This was necessary so that credit and financial institutions can fully play their role in financing companies in need. This has led to the CRR quick fix regulation recently passed. And last but not least, the ISF has asked the EBA to delay the publication of the EBA guidelines on loan origination in the context of the COVID crisis. The ISF has considered the guidelines are pro-cyclical and they will enter into force when public plans will end up and private lenders will be asked to finance the economy. And this is the purpose of my next and last slide. The EBA guidelines on origination and monitoring of credit were designed before the COVID crisis in 2019. With this crisis, which is different with anything in the past, the context is totally different. Despite some changes, they remain unfitted to specialized forms of credit. V2 is globally more respectful of the proportionality principle, and I agree with Oleg. But some requirements still do not fit with some specialized business models that have demonstrated their efficiency. I have 4 examples. guidelines requirements do not fit with intermediated lending activities, consumer credit on the point of sale, vendor leasing, or factoring. Required documentation cannot be collected, and creditworthiness assessment criteria are not applicable to the final client by the intermediary at the point of sale. The second example is that in France, there is no access to positive external data because we have no positive credit bureau. The third example, the customer single view is not possible in the French legal framework of banking secret and client data protection. And the last example, signal and justify any pricing below the cost is not compatible with intermediated forms of specialized credit. For example, in consumer credit at the point of sale, part of the credit costs can be covered by the intermediary partner. The second main concern we have is that EBA guidelines do not fit with the exceptional economic context. They are contradictory with European institutions' political actions, such as ECB quantitative easing or the European Commission best practices recommendation to financial sector issued yesterday. They are risk adverse and procyclical in the context of crisis. They will create legal insecurity for risk management teams and discourage lenders to play their role. They will restrict credit granted, and it may generate credit crunch for some segments of borrowers, mainly the most fragile. My last point is a question for all the panelists. Do EBA guidelines go too far? They are supposed to be non-binding in the European legal framework, but they are in reality almost totally implemented as hard law by the national supervisors. Several MEPs from S&D, EPP, and Renew Europe have recently raised concerns on the fact that EBA guidelines could go beyond the scope of competence of the EBA and contravene level 1 legislation. They could undermine the competence of the European Council, the Commission, and the Parliament. And the fact is that in France, some parts of the guidelines are contradictory with level 1 law that do transpose the Consumer Credit Directive itself. And it seems to be the same in other countries such as Belgium or Italy. Thank you.
Thank you, Françoise. I mentioned that you have raised a lot of questions which deserve some discussion, but before we have the discussion, I would like to move to Paolo. Françoise also mentioned, of course, the credit reporting agencies as having an important role in the credit scoring and assessment of the creditworthiness of borrowers. How do you see the guidelines and the role of credit reporting agencies?
Yes, I will come to this. So first of all, let me thank you also for participating in this panel discussion. Before coming to my view on the EBA, I would like briefly to introduce this concept of a credit bureau. Maybe it's not known to everyone, on the example of Schufa, which is the largest consumer credit bureau in Germany. One question, can you see my slides?
Yes.
Okay, great. So basically, credit bureau consists of a big database, and it collects credit-related data from creditors, which are generally banks and non-banks, And in exchange for this collection, those participants can make credit requests, and they are served with data on consumers. And we generally distinguish between positive and negative data. So negative data are financial payment difficulties experienced by consumers, insolvencies, and so on, which is very clear. Positive data is something also an important concept with which most credit bureaus have. I acknowledge that France is in another position here. These are basically three things. One is the credit request done by consumers, which are also collected. Then the loan information. So every participant sends to the credit bureau initial loan and obligation amount with the duration and the rates. And the third point are settled payment instructions. So once the payments are paid, this is also considered as a positive data. Now let's come to the points which I consider important from a credit reporting agency or credit bureau point of view regarding the EBA guideline. The first point is data comprehensiveness. So I think that including in the credit decision process, in the origination process, positive data and negative data on the consumers and also on corporates improves the predictive power and the possibility to distinguish between consumers which can bear the risk and consumers which are likely to default. This increase of predictability ultimately has a positive effect, one on the borrower, because it protects the consumer from over-indebtedness. And for the institutions, it helps to minimize the loan losses. So at a constant risk appetite, it will increase the loan volume. So in the effect, it will fuel the economic growth. The second aspect which I consider important is for the creditworthiness assessment is that scoring alone, although it's important, is not sufficient. So it has an important element, but I think the amendment of affordability checks is a very important point regarding borrower protection. And the point is that income information, this is the important point here for affordability, income and disposable incomes and costs, and those are typically not part of a credit bureau. And I think with recent technology and PSD2 and open banking, we have a good tool to do this in a high quality, efficient, and highly automated manner once the borrower agrees and gives the consent to do those kind of assessments. And I would say that even for low volume loans, it is important to include some kind of affordability assessment, not so much for the creditors, but for the borrowers, because even low volumes may be the straw which breaks the camel's back. The third point I consider important is the single customer view, and here it is important to be on household level. This is the risk unit, and to be also able to collect those kind of information across all creditors. This, of course, is a challenge for the credit institutions. A reference agency may help here because they have the loan information and other liabilities across institutions. But it is absolutely important that this information is provided by the borrower as well, because there are important information nuggets which are not available on a credit reporting agency, which is the household composition and the actual balances. At least at Schufa, we only have the initial balances. But I think ultimately the combination of institution data, borrower data, and consumer reporting data will be the solution, because this will allow to amend data, and to verify them, because this is an important step. In the online business, we know that fraud and misinformation is a very big issue. So I acknowledge that EBA emphasizes the verification and validation of data, and this will drive us forward. Thank you.
Thank you very much, Paolo. I think immediately that also raises some questions from the consumer point of view. For instance, of course, if you also would like to add income data, what does that do, for instance, to the privacy? On that note, and of course also many other elements that are important for the consumers, I give the word to Olivier, representing Finance Watch. If you have any questions for any of the panelists, you can raise them in the Q&A panel. Some of the answers were already given on the questions while the other speakers were having the introduction. Olivier.
Thank you, Will, and thank you, SEPS, for organizing this extremely interesting it's a webinar, and I'm very pleased to take part to the debate with you this morning. I would like maybe before to enter a bit more in detail on some of the information provided this morning, to just go back to some element of the current situation, I would say, and the circumstances that for a large part of the EU, let's say, citizen, will lead for, well, decrease in incomes, probably decrease in work intensity, that will maybe, of course, because of that, increase the risk of unemployment. There is a high level of uncertainty about the way people are going to recover their income, if they will recover their income. Is it in 12 months, 24 months, whatever, we don't know. So what I want to underline here is that the way to assess the creditworthiness for the time being is extremely challenging, because we don't know how people are going how the economy will recover and how it will impact concretely the European citizen. I also would like to mention that when you look at the figures on people at risk of poverty, which are, I would say, the public for which I'm really much, let's say, focused on, and my perspective is more to protect and to have a view on how to protect these group of people in the society. So we are about 22% of the European, let's say, European population that is at risk of poverty in average. And so these people do not have access to savings for the time being. They don't have access to savings to pass through these difficulties. They might not have already any margin in their budget to, let's say, to cope with a reduction of the income. So they might already be creating debt with their let's say, the landlord, or it can be with their current, let's say, and fixed expenditures. So these people are definitely facing high, let's say, stressful situation, highly stressful situation. And the risk, of course, of people meeting default credit because they already have credit, but they don't have the capacity to pay back this credit are, of course, very, very high. So in this situation, we just have to think about let's say, the psychological situation in which these persons are now facing. And it means that they might be tempted to look for credit because they need, I would say, in a way or another, financial means to survive. It can be really for essential, let's say, essential goods and services to access, but they will be in a very weak situation. And so they are not rational in that moment. They can't be rational. They just want to survive in a way or another. And so in this situation, of course, the solution has been broadly developed in Europe. We know that there are some loopholes, but globally, hopefully, let's say, the governments at national level try to guarantee a minimum level of income access to unemployment allowance. So there is a lot of, let's say, action to protect people, but unfortunately we know that there are people that have not been covered by this protection. And maybe this protection in some situation has not been sufficient to properly, let's say, face the issues encountered by these people. So it means that because of this asymmetry of situation, they might be tempted to access credit, short-term credit, maybe more, potentially maybe less proposed by bank, to be honest, and maybe less, and maybe more proposed by non-banking institution who are more, let's say, used and professional to make short-term credit, in many times with, let's say, a bit less advantageous terms and conditions, higher costs related to these credits. And to pass this period using a credit is, you have understood, a very bad idea, because we have no view on the capacity for these people to face the reimbursement of this credit in the short or mid-term. This means that responsible lending is a key practice. It's a key element to protect these people to become over-indebted. And this is really the responsibility of any lenders to refuse a credit in such a circumstance. And I consider that the political responsibility is on the government side to propose for these people sufficient income, I would say, to face this difficulty. So this is the first element. So I'm very, very pleased to read what EBA has, let's say, made in this guideline. I think it goes absolutely in the right direction, because I hear Françoise, of course, concerned about the fact that many people might need money to pass through this period, but creating debt and over-indebtedness situation for a long run for many people who so for the time being are extremely weak is not neither a situation. It's just, it's not solving a problem. It's just, to put the problems in the shoulder of people for the next years, which does not bring any good at the economic level. It's just, something like is not a solution. So this is very key, in my view, to protect people against this credit that should be considered as irresponsible, in particular because at the EU level for the time being, there is no tool, there is no process for all these people that might get trapped in this situation to get out, because there is no, for the time being, personal bankruptcy scheme. There is no, let's say, possibility for the EU citizen to have access to, let's say, some scheme that within a reasonable period of time allow them to access to a second chance, which is key for economical development and also for social purposes. The other element I would like to discuss and to comment is about the responsible lending, how to assess and how to make responsible lending a reality. Here it's all about, so there is one thing. We know that business model for credit lending is built on a certain level of credit default, okay? So now you mentioned, Oleg, that we reach at the average in Europe 2.7 NPL loan. So let's say that this is the average a reference level we can take into account. So I will say that depending on the business model, depending on the cost structure of the institution, depending on the product proposed, and of course the interest rate level, depending on all these things, companies might be keen to propose credit that might lead to higher level of default rate because they will make good business with that. Okay, so this is all about that. The idea you have, let's say, modelizing with your guidelines will change that rule, which is for me in a certain way a revolution. This is something for which I'm really happy, and I work for years for that, of course. But it means that this level of default that might be the right one for the business model of some lenders might be impacted and should be impacted when the lenders will have to take into consideration the creditworthiness of the customers. So this is something on which we might have a view on how the default rate will evolve in the future. But this is a key, of course, indicators about the efficiency of these guidelines. As regards the data to be used, we are all agree here, and I think I completely agree with the presentation of Paolo about the type of data that are necessary to assess. It's about the income, it's about the expenditures, and it's about the capacity for a household to have a margin to be dedicated to the reimbursement of credit. We all know that. It's very simple, very easy to understand. The question is how to access a high quality data that might be accurate, that might not be, let's say, with no fraud, so with no, let's say, manipulation by the borrowers. That might have an interest maybe to change a bit the data about his situation. And so how to access that? This is the first question. And in my view, open banking might open a door, an interesting one, to the appropriate data. Solution might be designed in a way to create appropriate Chinese wall, I would say. Should we develop, let's say, new players might develop analysis of the financial situation of the people based on the analysis of the transaction accounts of the consumers. And we can easily think about credit scoring or creditworthiness assessment based on the analysis of the payment account of the consumers. It should bring absolutely all information because it's about, of course, the non-paid rent, or you can identify absolutely everything. The question is how to make this, and maybe this is someone that might have been invited as well today, is about the privacy protection. And this is a key question. And that's the reason why I already referred to Chinese wall, but how to develop such a tool, because we know that on a bank account, you do have high level of information, and a lot of this information are not, in my view, and in the view of Finance Watch, is not considered as absolutely necessary for the sake of creditworthiness assessment. All the data that might be considered as metadata, for example, that are more comportamental one, might not be seen as necessary, for example, it should not be used for creditworthiness assessment. Many data are too granular in some extent, let's say about the expenditures. This is not necessary to know where people do consume, access the goods. We should not have access to the, let's say, protected attributes such as payment to, let's say, church or trade union, or all the expenditures related to health, for example, are extremely sensitive. So we should think about how an open banking, let's say, operator can develop a proper, let's say, creditworthiness assessment that respect fully the spirit of the GDPR. And this is probably a key challenge for the time being, which is how to develop that, how to design and to draw the appropriate perimeter of data that should also be made accessible for credit providers. In order for them, it's also a way to, let's say, improve the level playing field among the players here. It's key, in my view, because otherwise you will have, let's say, competition distortion between the ones that might access some data and the ones that might not. And at this level, it's extremely important, in my view, for the competition, the quality of the competition, that the perimeters of the data made available for creditworthiness is clearly defined. It does not mean the data, it does not mean the same level of, the same analysis of the data. You have to understand that. But the perimeter of the data that should be made available and aligned with GDPR is a key element, in my view, to be designed in the future, to help the competition within the credit market, and also to guarantee a high quality of responsible lending. That's my view for the time being. Thank you very much.
Thank you very much, Olivier. We still have a few minutes for some questions. I see that in the meantime, some of our participants have raised some questions. Maybe immediately to follow up on the points of Olivier. Basically, it calls for sufficient data to make a good enough creditworthiness assessment. At the same time, don't have excessive data. Then I also see one of the questions that we received from the participants that basically says, in the times of crisis, you risk that there is basically a limited competition in the field so allowing borrowers to move from one credit provider to another. If we connect it a bit, Pano, how do you find the right balance between, say, a proper creditworthiness assessment, in particular in times of uncertainty, on the one hand, and at the same time protecting the privacy of the borrowers?
Yes. Well, first of all, every single data element which a credit reporting agency has and will probably receive is based on consumer consent. Yeah, this is the key point. At least in Germany, consumer consent is key for the data to be able to handle and to give them also to the other participants. And this is especially true for open banking data. So basically, the consumer is in the middle, and he has an interest to give the information in order to make a sound assessment. And I think this is key. So once the credit-related data, and this is the important point, we are not so much interested in social media data, maybe for the developing world, but for Europe, I think credit-relevant data are key, and we need, I think, a proper mix of long-term data, yeah, which a credit bureau has, and also short-term data, which are provided by banks, open banking. And once the consumer gives the consent, we have the proper data set to make a worthwhile assessment. And at least from my point of view, a credit bureau could serve as an intermediary where those data are given consent to, where there is a processing and the result is given to different banks, yeah, so that data privacy is taken into account, or there's a minimal amount of disclosing information to third parties. But a certain level of trust must be there, yeah, otherwise it's not possible to work.
Okay, I see that.
If I may, William Peter, on data, it's interesting because we've been discussing the issue of the data quite a lot, and the loan by loan data and the credit and the data needed for the creditworthiness assessment. And here I would like to stress that the guidelines are here completely technologically neutral. I mean, what we are looking is the data regarding the not just income but repayment capacity. Repayment capacity can come from the savings, can come from the inheritance, not necessarily the income. So what we want to try to change with these guidelines is that the credit providers, and we are not focusing on all credit providers, we are focusing on banks because they are under the prudential regulations, and we are focusing on the mortgage lenders and the consumer credit providers under the MCD and CCD. So to answer Francois' point, not all specialized lending are covered by the guidelines, and we are focusing on plain vanilla loans here. But what we want to ensure is that there is a step change in the thinking of the creditworthiness assessment. There is assessment of whether the borrower can repay the loan or cannot repay the loan, using these various sources of the repayment capacity. And this is very crucial for the guidelines. And that's where we expect major change for those who are just relying on something else, social media, as Pano just said, but we want to do the assessment of the actual creditworthiness capacity. What we also clearly saying about the data is that the data can come from the borrower, from the loan application. It's usually with the mortgages, when you apply for the mortgage, you need to fill massive questionnaire, and that you provide to the bank, and that's the source of the assessment. It can come from the bank, or it can come from the external reference agencies. We are not making any preference for any. It's as long as the bank has this capacity and the bank has access to the data. The sources are either borrower, either internal data available to the banks, open banking, or anything. if we talk about the open banking and they're getting the information from the external agencies, obviously the GDPR requirements apply, and both the bank and the borrower should comply with these requirements. But the data is indeed very important point for these guidelines.
Okay, thank you very much, Olivier.
Yes, if you allow me, I would like to react to Paolo's last let's say intervention, because you mentioned the question of the consumer consent, and this is really something on which I would like to come back, because in my view, GDPR brings something extremely interesting, which is the principle of necessity. So we need the data. If we ask the data, it's because we need the data to finalize a contract, for example, if it's about a contract. And in my view, for the time being in Germany, there is a situation that is pretty much exceptional, actually, because I think this is absolutely something that we can't even imagine in Belgium or in France, which is, for example, when you ask for rent, or when you ask for, let's say, electricity, for furniture or whatever, in the contract, in the conditions, this is your data will be provided to Schufa, and you consent to do it, but you can't not consent. So the consumer consent is not a consent. I think you want electricity, you want to access your apartment. So you're obliged to, and in my view, it's not only my view, I think it's the view of the protection of privacy. This is not proportionate, this is not necessary. I think, of course, you can access electricity, phone, or whatever, without providing this right to Schufa to access this data. It exists, and I think in many other countries it does not exist. So this consent is not a consent. In my view, we can really reconsider this idea of consent. So I feel much more comfortable that when a consumer is looking for credit, that during this period of time, he will looking for a best offer. Let's say he is already wise and really rational and whatever. He will look to different offers. He will provide to the very precise potential lenders an access to the appropriate data for the lenders to make this creditworthiness assessment, the proper one. And he knows exactly to whom he has given the data. And maybe also, these lenders might only keep the data if they provide the credit. Otherwise, they should not even keep the data. And then we solve a gigantic issue, which should be solved by the GDPR, which is, I can't imagine that GDPR will push for more, sorry, of course, you understand, I might not fully enthusiastic with credit register, but we can't imagine that credit register at national level will create connection from a country to another, will increase the data, let's say, storage, private data storage, many times sensitive, exchange from cross-border at the era, within the era of GDPR. I think, in my view, it's absolutely a clash. And but the idea for let's say, the credit bureaus to much more goes into the open banking, and this, let's say, one-shot analysis of data, very clear, very understandable for the consumer, might be, in my view, the benefit from this the innovation that now is made available thanks to the PSD2. Thank you.
Thank you very much, Olivier. I think, Paolo, still, if you could answer in basically one sentence, because we already more or less reached the end of the webinar in time.
Yeah. One issue, we have, please take into account that you need also a longer time history. Yeah, open banking data is not typically only takes into account the last 3 or up to several months. But we have done a study where one person who had settled payment disruption 7 years ago will have 5 times higher probability of default compared to people without any payment disruption. So longer history is important. And I ask you one question: if you had something to offer, or a loan, yeah, and you do not know the person, then you would be interested to know how his payment reliability is, wouldn't you? Or would you just give the data based on a short-term history of 3 months? So this is, I think, the concept where for higher volume loans, it's important to store high quality credit information over longer periods of time to really make a sound assessment whether to lend or not to lend.
Just a very short response. Yes, I think of course the duration to access data and to make the analysis is the appropriate one has to be clearly let's say designed, and I think this is something that is also almost a political decision. Because also the right for a second chance exists, and I think 7 years is already a heavy, heavy pain to pay if it blocks you in accessing whatever. But I think no, for sure, I think it's 12 months. It's a minimum in my view. So, for example, I'm pretty agree with you on this, because also for 12 months you can't pretend to manage properly your let's say your account in order to access a credit. Or if you can do that during 12 months, you learn how to manage. So it's already a good habit that has been reached by the consumer. So another element that is very positive with these let's say tool based on let's say payment account is also that you can definitely help consumers to see, look, here you have this issue, you met these difficulties, because you can't save any money. So as long as you have this kind of red signal, this is the reason why. Once you maybe improve your budgeting capacity in order to solve that and that, then you will increase your credit access. And this is then pedagogy. It's really financial education, but really a concrete one. And it's also very easy then to explain the decision, the credit decision, which is also a key element, a very important element that we should protect consumers. They should understand why they are refused, why they access, and maybe why it's refused today and why not tomorrow. Because I think it's also about pedagogy. Thank you.
Okay, thank you very much. I see that there are still basically at least 1 or 2 questions maybe for Oleg to answer in the chat. I don't know whether it's maybe possible for Oleg to respond to those in writing.
Yeah, I am responding in writing actually to all of them.
Excellent. Thank you very much, because I think we had a very nice debate. Of course, it was also very ambitious to discuss all the different elements that are mentioned in the guidelines, as they are so, in a sense, comprehensive and trying to strike a balance between so many different areas of policy. So, but nevertheless, I think with the excellent lineup we had today, we managed quite well. And therefore, I would also like to thank Oleg, Françoise, Pano, and Olivier very much for participating in this webinar. So SEPS has regular webinars. The next one will already be tomorrow. It's joined with ECMI, and that will be on a completely different topic, and that's on derivatives is sustainable finance. If you would like to participate in that webinar, please go to the SEPS website and register. For all the participants in this webinar, you will receive the presentations from today's webinar by email, as well as that ECRI will prepare a short summary of the discussions today that will also be published on the website and shared with you in due course. So for now, thank you very much and have a nice day. Bye-bye.
Bye-bye.